If you maintain a checking account and you're past age 60, the IRS discreetly revised 3 rules this year, and none of those updates showed up in your mailbox. No mailed notice, no televised briefing, just revised enforcement instructions tucked inside compliance updates, and most older adults right now have no clue they're affected. I'm breaking down all 3 today. The figure you were told to monitor that no longer shields you, the routine banking behaviour the government now views as a warning sign, and the family payment that can quietly become taxable income. Stay with me to the end. The final one is the risk most seniors already carry without realising it. Hi, I'm Lana Mains. Each week I explain financial and legal topics in a way that genuinely helps you safeguard what you've earned and make retirement simpler to handle. If that benefits you, subscribe so you won't miss what's next. Let's start with rule number 1. The amount many seniors memorise was $10,000. Keep transactions below it, people believed, and you were protected. That belief is now incomplete. Under the Bank Secrecy Act, any cash transaction exceeding $10,000 in one business day still forces your bank to submit a currency transaction report to FinCEN. Your name, social security number, birth date, and the precise time of the transaction are reported within 15 days. You'll never receive a copy. The bank is legally prohibited from informing you. What shifted in 2026 is what the IRS monitors beneath that figure. New guidance focuses on accounts that show repeated deposit patterns under $10,000, especially for seniors receiving steady benefit checks, family payments, or retirement payouts. The limit is no longer your safeguard. The surrounding pattern is. There's also another report many seniors don't realise exists, and it has no minimum dollar amount. A suspicious activity report, or SAR. A bank may file one over a $200 transaction. Compliance software flags behaviour, not totals, and you will not be told it occurred. Federal law makes it a criminal offence for a bank employee to warn you, punishable by up to 5 years in prison. Also important, money orders and wire transfers above $3,000 require the bank to verify and document your identification under the same statute. Even though that level doesn't automatically trigger a report, it creates a scaled-down version of the same record-keeping already maintained by the government. This rule applies to credit unions just as it does to national banks. Smaller or local institutions receive no exemption. If you transferred your accounts to a credit union believing it operates outside these requirements, it does not. Every federally insured institution must comply with the Bank Secrecy Act, meaning the smartest step isn't changing banks. It's understanding what actually prompts a report to begin with. That brings us to rule number 2, the one that transforms an ordinary routine into a federal signal. Consider Diane, 67, a retired county clerk in Albuquerque. For 11 years, she withdrew $800 in cash every 2 weeks for household costs. After her husband died, she increased it to $1,000 to cover bills he once handled. 6 weeks later, her bank's monitoring software flagged the account and submitted a SAR. Diane did nothing improper. She was a widow adjusting her finances, and the system interpreted her consistency as avoidance. Diane didn't learn about the SAR until months later, when a routine account review at her bank highlighted discrepancies connected to the earlier filing, and a compliance officer asked her to clarify the shift in her withdrawal pattern. She managed to resolve it because she kept prior receipts showing the increase matched new expenses she assumed after her husband's passing. But she told me she had no idea until that discussion that anything had ever been filed on her account. That's known as structuring under Title 31, Section 5324, and it does not require intent. It only requires a pattern that appears designed to remain below the reporting threshold. Regular withdrawals of consistent amounts under $10,000 qualify, no matter the source of the funds or how legitimate they are. If you frequently use cash, the solution is documentation, a brief note each time listing the date, amount, and reason. If you're transferring larger amounts between your own accounts, complete it in one transaction rather than multiple smaller ones. Before we move to the final rule, review your last 90 days of activity. If you notice 3 or more deposits between $5,000 and $9,500, write that down. You'll need it for the steps at the end. Now for rule number 3, involving money that never seemed like earnings. Your daughter sends $400 through Zelle for groceries. Your son sends $600 via Venmo for car repairs. It didn't feel like income. But under revised 1099-K regulations, third-party platforms such as Venmo, PayPal, and Cash App must report total payments to your account once they exceed a set annual threshold, $2,500 for 2025 activity, gradually moving towards $600. Zelle operates differently because it functions as a direct bank transfer, so it isn't subject to this same reporting requirement, but the money is still taxable if it's actually tied to business activity. When a payment processor reports those transfers and they aren't listed on your tax return, the IRS system automatically flags the discrepancy. The notice you receive is called a CP2000. It's not an audit, but a proposed adjustment that includes interest. Patricia, 71, a retired home health aide in Memphis, received one in March stating she owed $1,840. She hadn't worked that year. Her 3 adult children had sent her $3,200 through Venmo for medications, utilities, and a replacement refrigerator. The IRS matched the 1099-K to her return and detected a difference. She had 60 days to reply before it became an automatic assessment. The solution: ask family members to write personal gift in the memo field when sending funds and keep a simple record. Gifts aren't taxable income to you, but you must be able to demonstrate that's what they were. Another detail many seniors overlook: the IRS generally has 3 years from the date you file a return to question it, but that period extends to 6 years if unreported income exceeds 25% of what you declared. That means a payment app discrepancy from 2 or 3 years ago can still appear today, even if no notice arrived back then. If you've been receiving steady family transfers through these apps for years without tracking them, consider downloading several years of payment history now, not just the current year, so you aren't surprised by a notice covering a year you barely remember. Here's what I'd like you to do. The exemptions, credits, and refunds most seniors already qualify for, but never claim. I've organised them all in one place, state by state, form by form, so you don't spend hours searching government websites. It's arranged clearly and quickly, so any senior can see exactly what applies. Regardless of your state, there's likely money you're missing. It's called the Senior Exemption Playbook. You'll find it in the first pinned comment below this video. Tap it once and you'll have everything you need. Stay with me, because the final rule is the one many seniors are already exposed to without knowing it, and it's why I created this entire video. Here's your action plan, and follow these steps in order. Step 1. Request your free ChexSystems report and review it for alerts or account closures you didn't know about. Step 2. For the next 90 days, record every recurring deposit, including source, amount, and date. If relatives send money through an app, obtain a one-line note confirming it's a gift. Step 3. Combine any planned transfers between your own accounts into a single transaction instead of several, adding a short memo describing the reason. Step 4. Total every Venmo, Zelle, PayPal, and Cash App payment you've received in the past 12 months. If it exceeds $2,500 and isn't reflected on your last return, assemble your documentation now before a CP2000 arrives. Step 5. If a CP2000 does show up, reply in writing before the deadline listed on the notice, typically 60 days from the printed date, not when you opened it. Include a concise explanation, supporting documents, and a signed statement. If the proposed balance exceeds $5,000, consult a licensed tax professional first. Step 6. Place a free security freeze on your ChexSystems file if you don't plan to open new accounts soon. It won't impact current accounts, but it limits how your activity pattern is shared with screening systems going forward. None of these 3 rules came with advance notice. Your bank cannot tell you when a SAR is filed. A payment platform won't alert you when it reports your family's transfers. That silence is written into the law. Understanding the real rules and keeping records as you proceed is what prevents a quiet flag from turning into a serious problem.